Hey everyone, how are you doing? I'm here with my man to talk about McDonald's, my number 3 favorite dividend stock of all time. What do you think about McDonald's?
It's a great dividend stock because I get trolls.
Where do you get these trolls? What kind of meal?
In Happy Meals.
Now, how many trolls do you have so far?
6.
Of these trolls, which one is your favorite one?
I like Barb.
That one?
Yeah. And she can make like 2 splits of her hair like this.
That's great. And would you say that we're going to McDonald's more frequently now because of the Trolls Happy Meal?
Yeah.
All right. Well, let's wave bye to everyone on the camera. So as a dividend stock investor, I want to share 5 lessons today that I've learned from this 2020 crisis, this pandemic, this stock market volatility, this economic devastation. 5 lessons that I have learned today, because life is different right now. Life is different. This pandemic has hit society. It has caused a massive, I would say, psychological change across society. I think a lot of the change is here to stay. And so, as explained in the intro today, I had my son on the video for a reason. I wanted him to share his experience at McDonald's, because as a family, we have been to McDonald's more, I would say, in the last month or so than we have in the last 10 years. I'm a McDonald's shareholder. I actually bought more shares of McDonald's last week. I will share those stats on the screen with all of you right now. And I'm excited to buy more McDonald's because for me, it's not only about the current valuation, but it's about the future. It's about what's going to happen over the next decade, over the next 2 decades, over the next 3 decades. And for me, I would rather buy a sustainable company, a world-class company, a company that's going to grow its dividend heavily at a fair price than buy a yield trap or a dividend stock that is on its way out. So let me explain. With McDonald's, what's happening right now is we're in what I like to call a winner-takes-all economy. We're on lockdown. We're stuck in our homes. Thankfully, fast food companies and companies of scale in the restaurant industry like Starbucks as well. I purchased some Starbucks last week. I'll share those stats on the screen as well with all of you. Those types of companies, they operate at a scale. They have the capability to process drive-through orders. They have the capability, the technological capabilities to process mobile orders. And basically, they are taking a short-term hit here in 2020. But when you look forward, when you look at the EPS estimates on a forward basis, things are getting better and better. And quite frankly, with McDonald's, I'm going to share some stats on the screen right now. It is so exciting to see that at the top of my stats, what I share here is 10 million thank you meals. One of the reasons I bought McDonald's just last week at a 2020 PE of 30, a 2021 PE of 22, which I would say is fairly valued, if not richly valued, is because this company is doing good. It is doing good right now, and it is building loyalty by serving these 10 million thank you meals. Not only are they doing what is right for the first responders and nurses, but they're building brand loyalty. And so the first theme today, the theme that I am hammering home right now, is what I like to call mega fast food chains. They're set to win. The mega fast food chains, they are totally set to win in my humble opinion, because I'll tell you, consumers now, they're a little bit more cautious as well. Consumers are stuck at home. One of the outings that they can do with confidence, quite frankly, is go to McDonald's. They can go to the drive-thru. They know that they're more or less going to be safe. They're staying in their car. They know that the employees at McDonald's are taking safety seriously by wearing the masks and the gloves and preparing food in a careful manner. And so this is one of the only outings that many families have now. And now you may be thinking the economy reopens, everything's going to go back to normal. I don't think so. Personally, I believe that the shockwave that has been set through the global economy so far has put many consumers, many families in fear. And so once these restrictions are lifted and people get back to quote unquote normal, I don't know if the old normal is what the new normal is going to look like. The new normal may be a more cautious consumer. And so for that reason, I love fast food chains. I think they are set to win. I'll tell you what's so interesting is my son, he has these Zoom meetings for school now because it's virtual school. School is not being conducted in person now due to this virus. And his classmates as well, they're going ahead and going to McDonald's as well. And we know it because on the Zoom meetings, his classmates are sharing these Trolls Happy Meal toys as well. And so I believe trend one, the fast food chains, they are set to win. And again, the numbers, they don't look that good this year in 2020. And I know there's certain chains, ancillary chains, like say Wendy's, for example. I'm not a big proponent of those. I'm talking about winner takes all. And when I think about winner, I think about McDonald's, I think about Starbucks. Those are the winners, and they are making the investments right now in 2020 to succeed like crazy going forward, in my humble opinion. And so this takes me to point number two, lesson number two. So lesson number one was the fast food one. Lesson number two for me, it's all about home. It's this trend of home being where the heart is. And so in my son's case, this is so fundamentally important to realize what happened with Universal Pictures and with the Trolls World Tour movie. So Trolls World Tour, it was set to open in the movie theaters. Instead of opening in the movie theaters, obviously because they're all closed, what happened is they went straight to to pay-per-view on just direct-to-consumer, if you will, pay-per-view on your cable. And so you could pay, I believe it was $19.99, something like that, and you could watch the Trolls World Tour. Well, as a family, being at home, where the home is the heart, and we wanted to do something fun for our family, we didn't even know what we were getting into, but we got into this Trolls World Tour movie, and honestly, it was pretty cool. It was really cool. The music was, I would say, outstanding, both for kids and to keep the adults interested as well. And so what I would say is this really reinforced that consumers can have a movie theater-like experience, a fun experience at home. And I'm just saying, when the restrictions are lifted, are we going to flock back to the movie theater, or are we going to think twice about, hey, well, we can have a pretty good experience at home as well? And it gets you thinking. Companies like Universal Pictures, are they going to do more straight-to-consumer, direct-to-consumer releases in the future? It's possible. And so from an investment perspective these days, no doubt I'm investing in McDonald's, I'm investing in Starbucks at fair valuations, happy to build those core stocks at fair valuations. Also, I'm thinking about stocks that reinforce this concept of home is where the heart. So first, I'll tell you, one of the stocks that could be at risk is Realty Income. This is a stock that I own, but there's a trickle-down effect. You think people are at home, they're not going to the gym as much. People are at home, they're not going to the movie theater. I'm not only talking about now on quarantine, I'm talking about when things reopen. The consumer's not just going to go, hey, going back to normal. Hey, maybe they will, but I think it'll take some time, and I do think there will be permanent scars left by the restrictive legislation that we're all facing now. There's a lot of fear out there, and as an investor, I have to just look at trends and how society changes over time. And the way that I look at it is the bread and butter stocks that allow someone to have a quality experience at home. They're going to be the winners. Companies like Realty Income, which own the real estate for the movie theaters, for the gyms. In fact, I'll share with you with Realty Income, 6.3% of their business comes from theaters, 7.2% from gyms, so 13.5% at risk. Look, it's one of my favorite stocks, and I'm just saying, as an investor, I have to have my eyes wide open. I have to look at the pros and the cons. I have to look at what's going on, and I would say right now with Realty Income, there is a little bit of risk. Still a ride or die stock for me. It's still going to, I'm still going to add to this stock. It's one of my favorite stocks of all time. But out of my favorite stocks of all time, perhaps this is one that has a little bit of risk because of their exposure, and I think the permanent scars that are left by this quarantine. It could affect them in the long run. We shall see. But check this out. With Trolls World Tour, they actually did $100 million revenue in their first 3 weeks. And what was so interesting is the last Trolls movie that was in the movie theaters, the revenue split, my understanding, between the movie theater and the producer is pretty even. It's the movie theater gets a lot of that revenue, but when it goes direct to consumer, what ends up happening is the movie studio, they get to keep the lion's share. They get to keep a lot of it. They have higher margins. And so not only was the revenue strong, but by going direct to consumer, they got to keep a bunch of it. And so economically speaking, from my analysis, at least, this Trolls World Tour has been a successful direct-to-consumer release. And so this is a trend for all of us to pay attention to, direct-to-consumer. I'll get more to this later, but PepsiCo, one of my favorite stocks of all time, they just announced that they launched Snacks.com. The reason they did this, golden domain, by the way, they're going direct to consumer, and they're allowing consumers to buy chips and snack foods directly from PepsiCo. And what's so cool about this is it's a technology move. Who said old world stocks can't make tech plays? But two, what's so exciting is there's free shipping. $15 order or more. And so I think Pepsi is making smart moves. This is what I'm saying is you see a trend, you see this direct-to-consumer trend, and you start thinking which companies in the portfolio are playing into that. Well, one of them is PepsiCo, and that's an example of a company that I'm going to continue to invest in, even at fair prices, because for me as an investor looking multi-decade out, I'm fine with fair prices as long as I'm buying quality dividend stocks that raise the dividend over time, and as long as I'm aligned with the right trends. And so this is just another reason reinforcing why I've been so focused on my ride or die core stocks. And so there's some other winners out there like Walmart, essential retail, providing essential retail for consumers who are at home. Like us, like many people out there. And so that's a trend. Now, I want to go to the third trend, the third lesson today. So we covered fast food, winner takes all from McDonald's, Starbucks. I'm a big believer in that. We talked about home is where the heart is, spending more time at home, quality experience at home, disruptive experience at home. I believe that's a lesson from all this. Another trend is just keeping the home well stocked. Here in the United States, at least, consumers are stuck at home. They are concerned, they are fearful, and so what are they doing? They are stocking up on essentials. And so many of the bread and butter CPG, consumer packaged goods companies that I own, are thriving. One example would be Kimberly-Clark. Shout out Kimberly-Clark. They make the Scott's brand of toilet paper. And we all know right now that consumers, they're stocking up on toilet paper. They're concerned about toilet paper. I think this is something that's going to happen into perpetuity now because we don't know when the next pandemic is coming. And because we don't know when the next pandemic is coming, the consumer is going to be permanently scarred here, stocking up on stuff. And so one of the takeaways, one of the lessons I see, and it just kind of fell into my wheelhouse because I'm so heavy on consumer packaged goods stocks, that you're seeing a resurgence, you're seeing a renaissance, if you will, within companies like Procter & Gamble, Kimberly-Clark, General Mills, for example. General Mills makes that Annie's mac and cheese. What a great company to own right now. They also make Blue Buffalo pet food, bunch of other stuff. What a great company to own in an environment where the consumer is fearful, the consumer is stacking up on provisions, if you will, to keep themselves and their families safe for this pandemic, but also for potential future pandemics. What a great stock to own. And again, in terms of stocking up on essentials, certainly there's winners out there. Look, I'm not a tech investor. I invest for dividends, cash flow, because I use dividends to pay bills. But there are non-dividend companies as well, like Amazon, that we cannot ignore, that are thriving and will continue to thrive from the consumer stacking up on provisions and being more home-centric. So we've got that resurgence of winner takes all fast food. We've got home is where the heart is. We've got those home essentials. Those are the first three lessons. So fourth lesson that I want to share with you all today is just the idea also of the home sanctuary. And so I see this playing out in my own life. We just purchased some backyard furniture from Costco, and obviously companies like the Home Depot, which is a company I do own, sells that as well. And I've been shopping a lot at Home Depot recently. I was just there on Friday stocking up on a whole variety of stuff, gardening stuff, light bulbs, other provisions for the house, because the consumer is spending more time at home. And I don't think this is just a short-term thing. I'm telling you, a lot of people are going to be permanently scarred from this. They're going to be thinking how they can spend more time at home. I just feel good about owning companies like Home Depot, and I'm willing to buy a Home Depot at fair prices, looking out multi-decades into the future, because I think that it is here to stay. And so it's this idea of the home sanctuary. People want to make the home nice. People want to go in their backyard. They want to have the furniture. They're willing to spend right now, even in a time where money is tight, even in a time where the economy is bad. People are stuck at home, and they want to do what it takes to make the home nice and to keep themselves sane, to spend time outside in the backyard, and quite frankly, to get to some of those projects around the house that have been lingering. I have a few projects that I've been meaning to get to, and I'm slowly but surely checking them off the list one at a time. I'll tell you, I have some teak furniture, and I spent probably about 20 hours. Starbright, shout out. They make the Starbright brand of teak cleaning. And so I used the cleaner, I used the brightener, and I used the teak, what do you call it? Oil, all from Starbright. And this, it took me a long time because I'm a perfectionist. I did a little bit of sanding as well to make sure the furniture looked really good. And, it looks like new, and this is teak furniture that previously had basically almost turned black from just all of the dirt and rainwater and just dust from over the years. And so this is a project. It was backbreaking work. It took a lot of time, but I'd been meaning to get to it for a while. And why did I do it now? The home is the sanctuary. I want the home and the backyard to be nice for the summer months, spring months, knowing that we're stuck at home because of this thing, and knowing that it's not just going to be a flip of the switch. And so who are the winners from this? The winners from all of this are companies, in my opinion, like Costco, companies like the Home Depot, that cater to people trying to improve the home that they have, make the home more of a sanctuary. And don't forget, there are regulated electric utilities. We're all at home. We still need electricity. And so I love owning regulated electric utilities as well in my dividend stock portfolio. And so a lot of winners come out of this. And it's so interesting that I think dividend investing in particular has a pretty bright future here, and I don't want to make light of a horrible, horrible situation, because this global pandemic, it is scary. My heart and prayers goes with the frontline workers, first responders. My heart goes to anyone affected medically from this nasty virus, and so obviously I wish this thing never happened. It is awful, and just the devastation economically as well to people. My heart is with people who are facing trying economic times. But what I'm trying to say is, from a dividend perspective, from a stock investing perspective, the types of companies that dividend investors own, like Kimberly-Clark, like McDonald's, like PepsiCo, like Walmart, like General Mills, like the Home Depot, like Costco. I don't own it, but it's a dividend stock. These are the solution. These stocks are the solution in this pandemic. It almost, it kind of highlights that, if you will. It allows these companies in some ways to face a renaissance of sorts, a resurgence of sorts. These are companies that are part of the solution. They're rising to the occasion. They're making the world a better place, and they're being rewarded for that. And maybe in the short run, they're a little expensive, these core ride or die dividend stocks, but over the long run, I feel good about owning them because I'm investing in the solution. I'm investing in good, and I feel that these stocks have a very bright future. And so in terms of the fifth lesson, I have made some strategic changes to my dividend investing strategy, some strategic and tactical changes that I want to discuss with you right now. The first one I'll tell you is it's related to coffee. I'll take a quick break here, by the way. That's good. Well, this is actually, I'm committing a sin here, but this is Costco coffee, actually. I bought the Costco cold brew. Very, very good. Sorry, Starbucks, but I'm at you. I got nothing but love for you. It's in this whole quarantine and everything that it's different being at home, and I kind of just looking for new trends, new things to do. And so I set this strategy that, hey, I'm going to buy Starbucks every Monday now just to start off my week right. And so the last few weeks, I've been buying Starbucks every Monday. This next week, I'm going to do the same thing. I'm going to share on the screen with you right now. I just bought Starbucks last week, and here are some of the metrics around it. I bought it $76. This is very expensive. The 2020 PE is a 55. 2021 is a 27, and dividend 2.14%, but the compound annual growth rate of that dividend is over 20% for the last 5 years. Staggering. Now, some of you asked me, why do you buy that with a 120% payout ratio? The payout ratio is very high this year right now because they're making strategic investments. They have more and more stores open. The stores don't have as much traffic because it's a different process now of mobile ordering, picking it up and leaving it. You can't eat in the cafe. But Starbucks is making these investments, one, to invest in their communities, and two, invest in their employees. Starbucks is here for my community when I need them, so I'm here for them with my capital as well. And the payout ratio thing, it's just a temporary thing into future years. This is a growth company. It's a tech company. One of the biggest mobile payment processor apps out there, are going to be even bigger after the pandemic. And the way that I look at this is the kind of companies like McDonald's and Starbucks that are setting it right with their employees, with their consumers. They're doing good things to the community now. Maybe the valuations in the short run aren't great, but in the long run, these are the companies that have the staying power. And for me as a dividend investor, another takeaway is just that staying power is probably more important than anything. And it's certainly more important than buying at a discount versus a fair price. I'd rather pay a fair price for a great company like Starbucks, like McDonald's, that has the staying power. And I'll tell you something else. The actions that companies take right now during the pandemic will be remembered, because this is a tough time. It's a stressful time. It's a challenging time. What these companies do right now will be remembered forever by consumers. And so even going back, I love this. This is why I had my son on the video today. He is having an experience right now with McDonald's. He's having the same experience, quite frankly, that I had with McDonald's when I was a kid. When I was just talking with family the other day about this. When I was a kid, we would go to McDonald's sometimes and I'd get Happy Meals. I remember, I can envision it in my mind. I remember what the kitchen table looked like. I remember where my chair was. I remember seeing the Happy Meal in front of me, what it looked like, having the TV over here on, my mom over here. I remember the exact scene when I was a little boy, what it was like having that McDonald's. And what's so interesting right now, my son is having a similar experience. He has these Happy Meals. He's getting the Troll Happy Meal toys. He loves these Trolls. He loves the movie. It's all being reinforced. It's a crazy time. He's going to remember this forever. And you know what this does? This sets companies up for generational success. McDonald's, it ain't going anywhere. And so this is something I've taken away as well, is just that, again, going back to point number one, but those mega fast food chains, winner takes all. But also setting things with the consumer right now is so important. And so anyways, this all came out of my Starbucks point. But the point of talking about Starbucks is just going back to me. I'm trying to set new traditions for myself. And so I had the McDonald's tradition of yesteryear when I was a kid, and now my son's having it. But I'm trying to set a new tradition for myself, which is just buying Starbucks stock every Monday, just to keep things fun. And again, I'm willing to pay up for quality, no doubt, a ride or die all the way. So what other tactical changes am I making right now? I am buying I'm just putting new capital into ride or die stocks. Ride or die stocks are my favorite stocks of all time. You guys have seen them if you've been on my channel for a while. I'll link in the description below to my last video where you can see the segment on a ride or die. What I'm also doing, though, is I'm selectively reinvesting. So ride or die stocks, I'm reinvesting. But dividends from other companies, I'm selectively reinvesting. So I'll give you an example. I'll share on the screen. Colgate paid their dividend last week. Colgate, for me, I love it. Got a lot of love. This is an example of a CPG stock that's going to do really well. Look, during the global pandemic, do people need toothpaste, toothbrushes? Yes, they do. And Colgate provides them. And I would venture to say that some people may even be stocking up on some extra toothbrushes and toothpaste just to be safe. And Colgate meets those needs. Nonetheless, Colgate's not ride or die. So what I did is I took my Colgate dividend and I reinvested it into 3M, which is a ride or die stock, making the face masks, making the respirators, making the solutions to get us through this pandemic. And quite frankly, when the pandemic is over, do you think people are going to stop buying these face masks? No. Governments, companies, individuals, all across the board are going to always be stocked up on face masks because of what could happen again. What if it comes back again? And so I love owning a company like 3M because they are the solution to the challenges our global citizenship faces. And check it out. This was one I actually got as a value. Out of all my ride or die stocks, it's a reasonable value. Bought it at 135, 2020 PE of 16, 2021 of 15, 4.35% starting yield. Compound annual growth rate on that dividend is a nice 7.48%. I'm happy that I bought more 3M. And so that is one of the changes that I've made as well, is I'm taking money, dividends from non-ride or die, reinvesting it into ride or die, not selling anything though. And so with that, I'm being more nimble. I'm investing in smaller tranches. Look, this market, I would venture to say it's probably going to plummet again. Maybe I'm wrong, but I wouldn't be surprised. And so I'm just ready for anything, and I'm ready for it by being nimble. I'm not putting all my money in at once. I try to go a little more aggressive on the down days when things are looking really bad, but I'm always buying. I'm always buying. That's what I do all day, every day, thug life investing. And so I'm buying, like I said, last week I bought 3 things. I bought 3M, McDonald's, and Starbucks, and it was a pretty expensive week to do it other than 3M. But if the market plummets again, I'm ready, I'm nimble, I've got some reserves ready to go, and I'll go even more aggressive. And so I try to lean into those down days, but I'm also always buying. But that being said, I'll tell you, when things skyrocket and they get to a certain level, I'm going to taper back as well. That's been one of my lessons here as well, is go a little heavier on the downside, not as much on the upside, but always remain nimble. What else? So I already mentioned this one, but companies that do good, they will be remembered. McDonald's, 10 million thank you meals, making it right with the kids with those Trolls toys, Starbucks, employing all those people, opening your shops, making it happen. Walmart, Home Depot, the list goes on and on and on. I feel so proud to own the companies that I own because they are the solution. I learned that I will not sell. I will not let negativity get to me. I talked about this in my last video, so I'm not going to reiterate it here. But I did a bottoms-up fundamental analysis, even on my companies that face dividend cuts, and I still love them. I will not sell, but I will selectively reinvest dividends into ride or die. And I'm prepared. On the topic of dividend cuts, I am prepared. I talked about Realty Income a little bit earlier. I don't know if they will cut their dividend. I don't think they will, but plus or minus 13 and change % of their revenue is at risk because of gyms and movie theaters. I think those are going to be soft businesses in at least in the short and intermediate term. Maybe longer term, they'll snap back. But I think there's going to be some permanent scar tissue in those industries, quite frankly. And my heart goes out to them because I love those industries. I want to get back to the gym, quite frankly, to do my swimming again. And so I can't wait until they open. And when they do, I will be back there and doing my thing. And so those are just some of the strategic lessons that I've learned as it pertains to dividend investing. No huge changes to my strategy, but it's more fine-tuning, always learning, always being open to what's happening in the world. But to summarize the video, the first 4 lessons I've learned, they're more trends, and that's kind of a closing thought that I want to impart on everyone is stay apprised of the trends, because the trends matter. Watch what's happening right before your eyes. Watch what's happening with your kids, because this is the Peter Lynch investing strategy. And at a certain point, all the numbers, all the metrics, all the financials, which I talk about here at length on this channel all the time, they're so important. But I rarely talk about trends, and I wanted to do it in the video today because they matter and because they should not be forgotten. And certainly people that are dividend investors that are looking to be in stocks for multi-decades, multi-generations like I am, The numbers have to be good, but at a certain point, it's the trends that matter too, because companies like McDonald's, they have staying power. And so if I buy that at a fair price or an overvalued price, I'd rather do that than buy a stock. Unfortunately, like I'll pick on them, but JCPenney, they're facing horrible challenges now, and probably not a trend that I would want to invest in. And so there are stocks like JCPenney, for example, that are kind of, I'll give an example, Macy's. Macy's an example. I wish everyone who's in Macy's all the best, but Macy's, it may look like a deep discount value here, but and maybe it's on sale or it has a good PE, whatnot. I haven't looked at it recently. That type of company is not for me. I'd rather go with the trends, pay up for the trends, because I'm in this for the long run. And I know that time compounding will do its thing for me. That's what will win it over. And I like to buy discount when I can on premium companies like I am with 3M, but it's so rare. It's so rare. But we'll see. Right around the corner, there may be another plummet. We'll see. All right, everyone. In terms of full disclosure, I am long the stocks mentioned today. I own McDonald's, ticker symbol MCD, Starbucks, ticker symbol SBUX, Realty Income, ticker symbol O, Walmart, ticker symbol WMT, Kimberly-Clark, ticker symbol KMB, General Mills, ticker symbol GIS, PepsiCo, ticker symbol PEP, Home Depot, ticker symbol HD, 3M, ticker symbol MMM, Colgate, ticker symbol CL, and Procter & Gamble, ticker symbol PG. I own all of those in my personal dividend stock portfolio. Important to mention in terms of a disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. It's good. It's good. I'm telling you, Costco. Before you go out and invest in stocks or anything else, please consult a licensed financial advisor first. Just sharing my journey here for fun and entertainment. I love you all. Please subscribe. Best way you can thank me. I'll see you in the next video. Again, stock market investing carries tremendous risk. Be careful. No advice here. Just sharing the journey. Love you all. I'll see you in the next video.